Good afternoon, everybody, and this is the last panel before drinks and then dinner. And I'm amazed the room's barely thinned out, although I'm not sure what happened here in the corner. Yeah, exactly, yeah. I'm sure they'll arrive later. The last panel is private equity, growth versus value, investing in Africa, the good and the bad, but certainly not the indifferent. And I've got an amazing panel today. There are 5 of us. And we will do a Q&A at the end of it, so have your questions ready. We won't do a census. We won't get you to put your hands up so you can relax and think about things. What I'd love to do very quickly is go down the panel, brief introduction each. Scott, will you start?
Thank you. Thanks, Rob. So first off, I just flew in red-eye from California, so if I say something stupid, please, I have an excuse at least today. Denham is an energy boutique specialist, spun out of Harvard 2004, has raised about $10 billion of AUM over that period of time. They've enabled me to carve out a program that's focused more increasingly as the world has changed on clean energy in emerging markets. It's not the only places we invested, but that's really the prime focus. We've invested just short of $1 billion since I came in 2007. Slightly over 300 million of that has been in Africa. We've been in South Africa with the wind and energy programs, Ghana with gas to power, Guinea with HFO to power, and then our newest platform, Temis, should be breaking ground on a hydro project in Cote d'Ivoire pretty soon, in addition to lots of other developments.
Karima?
Hello, I'm Karima Ola, and I'm from LeapFrog Investments. LeapFrog Investments is a social impact fund. We invest across Africa and Asia, and we're also an impact fund. The way we measure impact is we focus on companies that are producing goods and services that target the underserved emerging consumer. So it actually helps that we had the one before, because I think Cobra 360, Baobab, and Cellulant are basically perfect examples of companies in which we invest. The emerging consumer is low income, as well as SMEs, and anyone who basically is driving financial inclusion for that particular segment. And we have there's some great entrepreneurs across the continent who are. And what we tend to do is support them with not just equity, but also with expertise, and in particular for us, consumer centricity, so that as we basically use technology to produce scalability and affordability, we also ensure that there's also an element of consumer centricity to ensure that the product quality delivered to the emerging consumer is what they want. We started with financial services, and now we've also gone into healthcare.
Rob?
Good afternoon, everybody. Rob Withagen, co-founder of Asoko Insights. We're a corporate data provider focused on mid-cap privately held companies across the African continent. We exist because we see a tremendous opportunity, an investment opportunity in mid-cap corporates across the continent, but because of reasons of access to data, it's hard to find them, and it's even harder to do a cost-efficient due diligence on them with an investment purpose. So we provide that data on at the moment, about 55,000 companies across 25 markets across the continent. Work closely with the private equity community to help them in origination, market research, and due diligence. I guess I'll be the data guy on the panel today.
Greg?
Thanks, Rob. So I'm Greg Metro, work at Cerberus Capital Management, and Cerberus is a large US-based alternative asset manager with $37 billion of assets under management, investing across distressed debt, private equity, and real estate. And I'm within the private equity group in a group called the Frontier Markets Group, focusing on our group investing in Asia and Africa, and happy to be here.
And Greg, before coming to Africa, you covered Asia, is that right?
That's right. Spent 10 years in Asia, Southeast Asia.
Okay, so we're going to get a bit of a contrast between what's going on in Asia and private equity in Africa. It's quite interesting analysis. EJ.
Hello, everyone. My name is EJ. I'll make it shorter and easier than that long name. I run a business called FBN Quest Funds, which is affiliated with FBN Quest. FBN Quest Funds is the alternative asset manager of the FBN Quest Group, which is the asset management and investment banking arm of FBN Holdings, affiliated with First Bank in Nigeria. I'm Lagos-based. We're about a 15-year-old business that has historically invested on a proprietary basis on behalf of FBN and its various subsidiaries. We are now moving into managing funds for third parties. We invest on an agnostic basis in Nigeria. We've done consumer, logistics, oil and gas services, leasing, so sector agnostic, mid-market businesses in Nigeria for growth.
Thank you. So before we came in here and we were waiting in the speaker's room, we asked Rob, won't you throw up a few interesting statistics, which he did, and then there was a huge debate about what that meant. So we actually only really covered the stats before coming in. Rob, why don't you give us a few interesting stats, other than the ones we told you not to give?
And I've had a correction on one of the most controversial stat sets.
Go for it then.
I'll share the updated version. All right, first stat. Excluding North Africa and South Africa, we, Asoko Insight, estimates there to be 2,700 companies, give or take a dozen, earning between $50 to $500 million a year. Mid-cap space.
Revenue.
In revenue.
Okay, so just give that stat again. It's quite interesting.
2,700 companies earning in annual revenues between $50 to $500 million a year, excluding South Africa, excluding North Africa.
And do we think that's a lot or a little?
Well, why don't we raise the issue that you raised when we were in the room and how many private equity firms are in Africa focusing on those 2,700 companies? Do we have a rough?
Between 70 to 100.
So let's say 100. Do you want to do the math? Because Greg, this was...
Yeah, we were talking a little bit about this, and if you take 2,700 companies, and there's only going to be a portion that's going to be investable, there's going to be family-owned conglomerates, cross-holdings, and even if you say half of the 2,700, 1,350 across 100 funds, that means one fund has 13 investable companies. Seems like a low ratio, and yeah, I think.
So what are we missing here, Scott? We must be missing something. Or are you guys hoovering up all the good deals and no one else has anything left?
Or could that be the reason for lower returns in Africa relative to other continents?
We're going to get to that, yeah.
Yeah, well, I think what we've seen, right? We saw the influx of the large mega funds come in and then go out. You saw a lot of actually good exits in 2014 and then big fundraise in 2015. Both of those have declined, particularly in numbers, the total value. So what you have is, I think, a right sizing of private equity towards Africa, which is that it is more of a mid-market than a large cap play. Particularly in my element, we're doing development of projects, wind, solar, gas-fired, smaller hydro projects. It takes time, and it's hard to do in the context of Africa alone. We do it across Latin America and Southeast Asia as well. And you've seen big firms come in and say, well, they can't really push the needle so much doing development in Africa. It takes time, and they need to move dollars out. So I think what's happening is you've got the right sizing of more mid-market focused. I'm competing against someone I don't even know.
He's going to get to the punchline at some point.
So more of a mid-market focus where you get more value creation, I think, in general, as opposed to typical and I'm not, look at the large, I'm talking about 100, 200, $300 billion private equity outfits have added a tremendous amount of value over the years across many industries, so I'm not slighting them, but the traditional take a highly levered approach. Let me pay down the debt, I'll mildly increase the EBITDA, and then I can exit and bake in a 2.5 times return. That's not a typical play for Africa. It's become increasingly difficult everywhere, but you have to be growth, equity, PE focused in Africa to make things work.
So just talk quickly, growth versus value, and maybe we can all contribute here.
Well, I mean, so the Africa all-in returns haven't been stellar for PE and venture capital. They haven't been horrible. They haven't been stellar. Why do people want to put more money into it? Because of the population, because of the growth.
Trends.
Right? So what you don't have are mature businesses that people don't see much value in, and therefore, the Warren Buffett type approach, I'm going to come in, I'm going to take this company over, and over the long haul, it will outperform. Instead, it's about growth in every single area. It's urbanization, it's a young population, it's all those trends. You can take every single trend that's growth-oriented, and Africa clearly is a compelling feature for that. So it's not the history which is, we'll talk about LPs. LPs love, it's hard to get fired when you just made good returns with a fund and now you're coming back and doing the same thing.
But if we're talking growth and the trends driving the growth, then surely the hold period has to be longer. So private equity firms are usually limited by the hold period. Do you want to give me?
That's one of the reasons, I think, why you are seeing people coming into the market, it's strategic. So we're in financial services, and one of, where we, in insurance in particular, where we've seen strategics come into the market, it's because, especially in life insurance, it's about what, the demographics in the traditional markets, where, it's more and more an older generation, and then you're also seeing trends on mortality, and this is what impacts life insurance and pensions. And so what we're seeing is that whether it's AXA or Prudential US or Prudential UK, is that they're taking a view that when they're looking at their global portfolio and they're looking 25 to 50 years ahead, where is the majority of the working population going to be? But then they can afford to take that bet because, first of all, they have a lower cost of capital and a much longer environment. And if they have to compete with PE that's looking on a kind of 3 to 7 year, it becomes very difficult to basically match on entry valuations and multiples.
Yeah, and to your point about the term hold, I think we need to get away in Africa from thinking that we need to have models that mimic what has been done in the West. We need to do it differently. I think this came up in the previous panel as well. We need to do things differently. You're right. It's going to take a lot longer to season a lot of these businesses. You just mentioned how that mid-market is very limited. There's so much that we're missing that's in the smaller market, but the capacity to build those businesses is not even there. And if you do find a diamond in the rough and you grow it over the course of 6, 7, 8 years, you're still not done. I personally think that more private equity managers need to be doing more together. If I'm at the small end of the market, I should be able to sell my business after 6, 7 years to somebody who's operating in a larger end, and so on and so on. And by doing that, you don't deny the companies the time they need to grow in the hands of private investors.
And why aren't the traditional secondary funds in the market then? In Africa.
I was just going to raise a point to EJ's point, which is, well, if the traditional model of LPs in terms of the 10-year fund life, if it doesn't work, why doesn't it work in Africa? It seems to work everywhere else in the world. And then that raises a bigger question, well, how do we transform like how LPs think? And I think that's a really uphill battle.
That's a harder question to answer, absolutely. But I think it's not as though you can't make money in your 10 years, even with a startup business. You can actually do quite well with startups, and I think you're starting to see increasingly more managers doing more on the venture side. But do what your expertise allows you to do at your stage, and then move on to someone who operates more, if you're going from literally a Series A and you're moving a business along to a growth stage, there's a whole different slew of activities and expertise that's required at that stage before you continue to grow these businesses. This also speaks to why the availability of capital market exit opportunities is so thin for these businesses, because it's going to take them time to get ripe.
Well, EJ, I think you're spot on, and I think it answers Greg's point, which is that we've been in Africa since 2008 on the energy side. It is the right thing to do to substitute for capital markets and name brand strategics who are coming down buying things, to have actually private equity, later stage private equity with larger AUM step in and take things over. I mean, if you look at the United States power projects that dominated from, say, 2002 to 2012, it was all merchant combined cycle gas turbines that one private equity firm was buying and selling to another private equity firm. Nobody complained. That was happening left and right, and until people started bidding crazy and it put a couple funds out of business, generally it happened. And I think that's what you need to do, is attract more private equity buying things at a later stage. So smaller private equity firms, smaller AUM, can take a little bit more time to develop things. It's not a finished product, but it's pretty far along when later stage private equity with larger AUM can step in and take it over and make more of that business.
But why isn't that happening naturally?
I think it is starting to happen, actually.
Okay.
Yeah, we're seeing some examples. I mean, I think I mentioned that we've made a number of exits to strategics, but with the last two exits that we made in our fund, for example, were to other private equity firms. I think every private equity firms, as a preference, prefer not to sell to other private equity firms because, it's a bit, they negotiate exactly the way you negotiate. They don't pay, they want you to leave something on the table. They don't always pay the highest multiples, but I think, needs must, and we're basically sort of meeting each other halfway. Which means that we also do a little bit more work in demonstrating what value's left on the table in order to justify for them paying a bit more.
So the holding periods are longer. The returns have been questionable. Do you want to, Greg, tell us a little bit about Asia versus Africa?
Yeah, sure. And I think the question on the holding period being longer, I was just thinking about that a bit more, and probably partially due to deal sizes being smaller. And one thing I've seen as we were part of SGI Frontier Capital and got acquired by Cerberus, and before our deal sizes were 3 to 12 million, now it's $30 million and above. And the companies we're looking at now are more liquid. Like, we can find strategics, we can list them on exchange, we can sell to private equity. And previously, with our smaller deal sizes, really it was private equity and maybe a local strategic. There wasn't an IPO route, there wasn't as many feasible options for our smaller companies. And I think Asia has much more efficient capital markets, both on private and public side. And the buyer universe is much bigger. You have mezzanine funds, you've got senior debt funds, IPOs in almost every country are viable. There's liquid stock exchanges. So I think the deal sizes are bigger and they're a lot more liquid and easier to exit.
Scott, you mentioned some statistics. I think you looked them up in the room beforehand on the returns, Africa and Asia. I know Asia's a very big basket, and Greg, you were mentioning that the Philippines and other countries really only come on stream somewhat recently.
I mean, they were where a lot of African countries were, 10, 12 years ago when I was working there.
Yeah, well, I mean, it comes down to what I think of as discerning LPs, right? And I think LPs have a hard job, so let's start out. I think we have to be sympathetic for them. They don't get rewarded for taking tremendous risk. And if they turn around and did something that, someone had a hugely successful fund, and even though a lot of people are saying, well, a lot of that was because in their mark-to-markets, they haven't had that many realizations yet, or, there's a lot more competition in that field, and so their returns are going to get compressed. That LP is not going to get fired for turning around and putting $200, $300 million into that mega fund versus pulling out 50 or 100 million and doing something different. And so when they look at, kind of returns, Asia, PE, and VC, 1 year returns 16, 3 year almost 14, 5 year 16, 10 year 14, versus Africa, 1 year, it's irrelevant really for PE and VC, but it's about 7%, and then 4%, about 3%, and about 5%. So it's not horrible. There are some, this is a geographical breakdown, there are some that are horrible. It's just easier for them to do that. And so what you need is somebody who's willing to get their investment committee on board, that this is a good part of a blend of what we should be doing. Yes, I've got exposure here in the US and in Europe, and I've got my Asia exposure, but I'd like to put some money here because I see over these next 10 years, this is where we can make money. And that's the discerning sort of LP you need to attract to this. Although occasionally you have people who just say it has to be Africa. Those are great people too.
So let's talk LPs now. It's a good time. I mean, who are the LPs out there? What are the new ones we're going to be looking at? Is there a category of LP missing in Africa that needs to be developed? And I know some of you wanted to talk about local LPs. So who wants to?
I'll start with the local view because that's something that's very close to what we're doing at the moment. I find it quite disappointing that the vast majority of capital that comes into the African private equity market is coming from international sources. I think it's fantastic, but I think you always want a model where your local capital kind of leads and the international capital follows. Why do you want to take a bet on a market where the locals haven't even taken that bet? And as Scott said, it goes back to incentives. I spend a lot of time with Nigerian PFAs, pension fund administrators, in other words, pension managers. And they are perfectly happy investing in, I guess now it's about 12.5 to 13% T-bills all day. and doing nothing else. I mean, they're not incentivized to take that bet and do something longer term. However, how do we get our market off the ground and continue to drive returns without that kind of local commitment? So I think we need to see a lot more of that. And as we'll continue to talk, I think there are some structural and infrastructural challenges around private equity in general that masks some of the fundamental value in these businesses. When you sort of take the dollar out of the picture, at least temporarily, you can start to demonstrate the real value in these businesses, and then we can tackle the infrastructural challenge.
That's true. The currency issue is a major negative.
And on the LPs, I was just going to say that I started working in Africa PE 5 years ago, and my expectation and hope, and that was still at the end of the Africa Rising story, was that, commercial capital is going to come in as private equity gets proven. And 5 years out now, looking back, I haven't seen a lot of commercial capital come in. But I think we're an exception to that, in that we originally, as SGI, had a lot of DFI money. And
what do you mean by commercial capital? Sorry.
So I'd say non-impact funds. So the U.S. pension funds, sovereign wealth funds, fund of funds, the larger ones that are global, that invest in Asia in a big way, and the largest investors in Asia, private equity funds. And they're quite small in Africa PE. So that trend hasn't played out, but with us, I think it was a good case study where we were DFI-based money, and then we're acquired because Cerberus saw an opportunity in Africa, Asia as well, to deploy commercial capital through their funds and eventually raise a fund for us.
Well, we're fortunate on the energy side. It just, other than South Africa, it just happens in the rest of Africa and many of our other markets that they'll transact in US dollar or euro equivalent. You can't ignore affordability as an issue. So we spend a lot of time thinking about, so if that currency gets totally whacked, it happened to me, I was only 10 years old at the time, but it happened to me, the Asia financial crisis in '97. I'm joking, obviously. So it was a large project in the Philippines, and all of a sudden the peso got wildly devalued. And so you have to look to your left and your right and make sure that you're not the worst situated. You're not the outlier. You're not the person that is going to get brought to the table and renegotiated because of that. And it worked. It worked for us then, and I think it's working mostly where we see it across Africa to date. And then you get sort of an indirect dirty hedge in South Africa with inflation protection on your power purchase agreements, and that's worked for us there. And in Brazil, we have the same situation. I think it's, we have put a lot of money into Brazil. And we see LPs go, well, why do I want to go into Brazil? I had all these fantastic infrastructure, real estate investments, and I got whacked like crazy with the real moving around. And we're able to differentiate, thankfully.
So I think if I talk about we've just closed a fund, so I can speak about, and it's our third fund. And if I was to compare the LP makeup for the first fund compared to where we are on this latest one, I would say the proportion of what we call impact LPs, so DFIs, are basically now a much smaller proportion. And I think one of the things that we have to remember is that, as Greg said earlier on, Africa is still where parts of Asia were, say, 10, 15 years ago. And so there's an element of infrastructure that still needs to develop. And the DFIs have been crucial on that. They've been crucial, in terms of people talk about governance, but some of the demands of DFIs at the early stages when we were basically initially starting our investment are basically laid the foundations for us to be able to then be attractive to more commercial LPs. What I will say is, in terms of, so we've seen more US pension funds. We've certainly had a lot more US private or commercial investors than we had in Fund 1 and more than we had in Fund 2. The other thing that I would also say, which was quite big for us, which is a big difference, is that we actually also saw a lot of family offices where for them, it's where the capital preservation, but also doing good and doing well. It's not a concessionary return model, but that also is also becoming really important. So even with Africa being, there are still certain infrastructural issues that still need to be dealt with. And I would say when I look, we invest across Africa and Asia. Yeah, we've got one IC, so the same team, the same investment team, look at everything, whether it's Africa or Asia, even though I'm responsible for Africa. And what I will say is that when I look at our entrepreneurs in Africa relative to ones in Asia, our Africa entrepreneurs have to work significantly harder because one, there is, the bench of HR talent, of talent in Asia is just significantly broader. People move a lot across, it's a lot easier for people to move across Asia than it is in Africa. And then the second thing is that sometimes the regulatory infrastructure, it's at a sort of later stage than for Africa, but it's changing significantly. And that's some of the job that we as LPs, I think it's very rare that we have to go and sit with the insurance or the banking regulator in Asia, but we do that on a regular basis in Kenya or Nigeria. But it's one of those things. And as Greg says, in another 10 to 15 years, it will mean that we get to where we need to be.
Rob, I just want to check if you've got another stat to throw out here.
I do.
Sorry, before you do it, Greg, carry on.
I was just
Be
going to
ready.
say that the question on human capital is an interesting one because, there's still a lot of expats in African private equity. And if you look at Asia, there's hardly any anymore. And that ecosystem of locally grown talent that have the technical skills and the relationships, it's fully there. And it wasn't in 2005 when I was first out there. And I wonder, is that happening in Africa? In Ethiopia, where I have a team of 6 investment professionals, it's still mostly expat. And I've seen it changing a little bit, but I'm curious across, your markets.
Certainly in Nigeria. I'll let EJ answer that one.
No, it's completely right. No, it's completely right.
Yeah.
What Karima said, we need more capacity. We need more capacity as investment managers, and we need more capacity for company managers to build. And what Rob said earlier about just the thinness of that mid-market underscores the fact that we have all these small companies that need to be built up somehow. And it's going to take a lot of capacity, it's going to take a lot of people, it's going to take a lot of management expertise, and it's just not there. And that's part of really what's holding us back. So I love it when I see groups that come up and are focused on just educating and sort of just building capacity and management strength. When we talk about ecosystem, these are elements of the ecosystem that need to come on board and help us build this out.
Rob, hit us with a stat.
Well, just I guess a statistic, just continuing a bit on the topic of DFIs. Around 250 registered private equity firms focused on Africa. About 70 to 100 are actually actively investing. The rest are in raising mode in some shape or form. So I guess that gives a sign of the large demand. DFI has taken a dominant position in the supply of it. Feedback that we get a lot from the GPs is that the alignment between their investment mandates and what they see as a realistic opportunity to allocate money is not always in line with the restrictions that the DFIs are imposing on the GPs, particularly when it comes to sector, country, ticket size allocation, which is often a copy-paste from what's being applied in other markets, to your point, EJ, which just, I guess, illustrates a disconnect between that particular DFI LP money and the GPs trying to raise it.
So do you think a lot of fund managers are orienting their fundraising to what DFIs want?
I think they're forced to because the supply is so limited that they're having to tweak their investment mandates to the bit of cash that they can bring in.
New managers often find themselves in that position
Yeah.
because that's the first source
yeah.
of capital, and they need to get the money to get off the ground, so they're kind of forced to. But to your point, Karima, you've come to a point in your firm's history that you've got all these family offices and other institutions coming in. You don't need to be as dependent. So we're
still speaking to DFIs, and we do, and when there are issues like that will basically either interfere with our strategy. We found that we were able to sit down with DFIs and find a sort of happy medium that works for both sides. But I agree that if for a first fund, it's probably a little tougher.
And I guess we've seen a lot of new first funds, particularly when the mid-cap opportunity has opened up over the last few years. There's a lot of local, regional plays starting from scratch, and inevitably they don't have the reputation behind them to tap into a diverse pool of cash, and that's where the the DFIs are often asked to be a little bit more flexible than they're willing to be.
So we're going to switch to the floor now, if that's okay, unless anyone wants to make a point. We've covered a lot of the areas. Question number one.
Franziska Hollmann, I'm from one of the DFIs you were talking, and we invest as well as in private equity funds with equity, obviously, and directly with equity in private companies. Being a bit self-critical, and I can be self-critical because I'm a debt person, not from the equity space. I really wonder, after having heard all the days discussion today, whether it's realistic to expect a US dollar or euro return in Africa on our equity investments with the industrialization gap, with the technology gap. I mean, where do you generate, and DEG, we finance we analyze very carefully the FX risk. Where do you generate FX income? It's from exporting industries. And this is in Africa mainly the extraction industry and agribusiness, which is not really an equity play, in my view. So industrialization, technology, etc., every one of these industries which create value, these are local income generating businesses. So I really wonder whether this is, what do you think about this question? Is it a fair assumption to expect double-digit, US dollar euro returns?
Probably not across all sectors. I mean, I think if where Scott and I probably are is when you have an underserved population that's paying significantly more for the consumption of energy, financial services, healthcare, health insurance, everything, and you're able now with technology to be able to provide that service at a much cheaper rate. And you've got a significant proportion of the population who are currently not covered. So you've actually got significant growth, and you're able to deliver it sustainably profitability at a price which is significantly less than those current consumers are paying it. That growth helps offset some of that currency risk. I agree with you that currency risk is still there. And in those sectors you mentioned, it is not reasonable to expect that you're going to get your 25% return in USD on that basis. But where there is a large proportion of the population that's underserved and there's an ability to be able to serve them at lower profitably, I think absolutely. And so a mix of that, as well as diversification across the continent, should still be able to get us closer to an expected return for USD investors.
And so we're advantaged a little bit, because as I said before, the power projects, wind, solar, everything, they tend to transact US dollar, euro equivalent. And by the way, not just because you said that, but I'm a fan of actually having DFIs in our deal, because in our deals and in our fund, because it actually helps us a lot more when you're dealing with governments in terms of getting paid and all that sort of stuff. And so that's, knock on wood, that has never been an issue for us getting paid across Africa, Latin America, Southeast Asia. But I think to Karima's point, why is this different than Brazil or India, where or Mexico, where the large institutional investors want to back up a pickup truck and just put it in there? They have the very same issue in terms of currency volatility, and now we're seeing that the sort of political sort of issues that have predominated that aren't just limited anymore to the developing world. They're starting to impact the developed world. And so the larger investor base, the larger institutional investors, they do want to take a position of having some exposure on FX naked and some not. And there's no reason why Africa can't fit in that bucket as well as anything else across a big sphere where all the population is in the world, all the population growth is. Sorry for all of us who, like me, who live in London, but that's where it is. And so longer term, they feel they have to invest in the emerging markets because the developed markets are relatively much more stagnant.
And just to add an example, just because it's much easier when you can follow something up with an example. We exited a Ghanaian business last year, where we, over the course of our investment, the CD lost, about 50% of the value, and we're still able to get exit at 1.5 times, and sort of about a 15% IRR in USD, significantly more in local currency, of course, but certainly respectable in the context of Africa. And I think it's that the kind of volume of underserved that basically helped us make that leap.
Yeah, and it's going to be different for every deal in every sector, but I would argue that we shouldn't shy away. It's a little bit controversial, not a lot of people see it this way, but we shouldn't shy away from using a variety of financial instruments and structures. I'm sure everyone has had a conversation around hedging, which I know can be costly, but I spend a lot of time with our structured products team within FBN Quest, and we've been able to develop some very interesting structures that work in private equity as well. In addition to that, you utilize financial instruments like mezzanine, like convertible structures, and you try to balance that with the natural growth that's going to come from some of these businesses, and you can get yourself to the type of return that you're looking for, even in dollar terms. But we need to get creative. The old models are just not going to work.
Right, question to the floor, Sanjeev.
Hi, for my sins, I also work for a DFI, but we don't invest in funds. So my question is completely objective and independent of what I do. You mentioned something to the effect of identifying diamonds in the rough. I like that. You talked about the fact that it's possible to get the sort of returns people want, where there is clear arbitrage, if that's the right way to probably put what you were saying. My question is, as the industry that you represent, are you positioned well enough to be able to identify those when you know that most of them tend to be very small and therefore probably below your sort of minimum rules of engagement? And secondly, do you have the capacity to provide what you said, mentoring and the corporate management? That was your word, corporate management. Because without that, those diamonds in the rough are probably going to turn into something darker, right? So, yeah.
So you talk about two different things here. So I think when, I'll address the first one first, which is just, can you deal with the, given the number of, there are only 2,700 in all of us, and most of the majority are below, can we deal with those? The answer is probably not, because what we don't have is actually the number of companies with revenue below 50 million, but I imagine they're probably in the millions. And in order to deal with those, if you basically think you're earning 40 million in revenue, you're making 40 million in revenue, probably earning 10 mil in profit 10 times, and then how many of those do you have in a fund? We're talking about and so the 2% model, and so that is where development is required, and we need to find a model that works for that, that's then going to kind of feed us. And I don't have the answer to that. On the ways, within our ecosystem, what we have done internally to make sure that we're able to do that is actually, something that's quite unusual probably for private equity funds, is we have a consumer centricity team, where whenever we invest in a company, we basically spend a lot of time in investing to make sure that we help our companies understand what it is that the consumers want in that, and it varies, right? So if you're a market trader and you're using mobile money in Lagos, it's probably very different than if you're in the rural parts of Ethiopia. So that's something that we've invested in, which actually does mean that in terms of costs as a manager, that's quite expensive. And the other one is talent acceleration, where, because we know that there is a very sort of narrow bench of talent available, what we're doing is we're working with our companies to help them get that training. So we hired a talent acceleration expert from E&Y, who in turn has basically then, as soon as we basically close, within the first 100 days, there is an element of an assessment where that team go out and they basically help them understand and identify where the gaps are and how they can find people to train internally. One example of that would be actuaries within insurance. I mean, there is a dearth of actuarial expertise across our market, especially in West Africa, less so in South Africa, and possibly East Africa. And so over the period of our investment, we put quite a lot of investment into ensuring that they get that training internally. So yes is the answer to your second question.
I think this is part of growth equity period today, where if you want to be more than just a surrogate for the capital markets, you want to differentiate yourself in order to tell LPs why it is that you're deserving of certain fees and certain carry and all of that, then you can't just be a financial investor. You have to be very value-add oriented. So we're going to be close to $300 million invested in Ghana by next year. Our portfolio company there started off with 5 employees and 0 revenues. 0 revenues. That's typical for us. It's for us in Brazil. We showed up in Brazil in 2013 with 3 employees, 0 revenues, and now we have 285 megawatts spinning, 51% female, 90 employees, and it's a model of, so you have to do that, and that's what I think we're doing with Endeavor Energy in Ghana and Guinea, what we've done with Biotherm in South Africa. We're starting over again with Temis throughout Africa, but based in Casablanca. So you have to differentiate yourself in equity. You can't just be writing checks if you're in the growth equity phase.
And I think I agree fully with that. And the team that we have is on the ground in Ethiopia. And for any new countries that we invest in, we're going to put someone on the ground. And I think part of that is the Africa challenge and communications and working with entrepreneurs that might not be as sophisticated. But it's really essential, both for sourcing deals that aren't part of auctions and then adding value to the companies that you invest in. It just makes it a lot easier.
I think to the point of discovering the diamonds in the rough, I mean, there is a need for a more structural data access on the continent, particularly on these smaller companies. And deal sizes are inevitably going to be smaller. For a PE firm to put in the expensive resources of identifying enough companies that eventually a deal can flow out of becomes an economical problem. And there are, and my company is part of that, there's an ongoing development in the information discovery and the information dissemination on smaller companies, particularly as fintech starts to play a role, starts to generate more information on creditworthiness of smaller companies. Companies like mine and many others are able to use that information, digitize it, and make it available to the wider community. That will inevitably, hopefully, I mean, you guys will prove us wrong, but get you to those diamonds a lot quicker and at least lower that entry barrier of getting the companies on the radar in the first place. That does not address the need for mentoring, but just the need to identify and know who your mentoring audience is under aggressive development, I would say.
And if I could just add something very quickly, which is on that front, I think the DFIs have actually been exceedingly helpful. I mean, CDC, for example, announced last year that they were they basically, I think, 100 million in venture capital, which is clearly kind of goes towards some of the smaller players. And the DFI has been really helpful in that. And one of the things I want to say is that when it comes to training, whether it is what I mentioned before, consumer centricity or kind of deepening the we use our labs function within that. And what we find is through blended finance, we've actually found that some of the DFIs as well as foundations have been willing, but it's where you can marry the needs of both, whether it's cash in, cash out of remittances, or you basically find a way in which where there isn't a commercial imperative, if you basically bring the two together, you can actually then start that off. And I think that helps. So the question is, if you're a small distributor of Coca-Cola across Nigeria, for example, you're neither VC nor are you big enough for the likes of us. And so there has, to develop that ecosystem, there's a requirement for a little bit more.
So one more question, maybe.
Thank you very much. Ibukun Adebayo from London Stock Exchange Group. Fascinating panel. I just had a question which is to all panel members, actually, and maybe just a brief comment before I make that question. We're all looking at this gold standard at the moment in terms of the UN's population division, which has benchmarked Africa's growth related to the population opportunity, i.e. that I think by 2050, Africa will have in excess of 2.5 billion people, and that's really where that opportunity lies. Now, I have a personal interest in that because I think Nigeria is supposed to become the 3rd largest country by 2050 as well, and I've always wondered whether my name would be as popular as Singh or Wang. Now, in relation to that, there's also been a suggestion that those figures are somewhat spurious on the basis that population is driven by fertility rates, and as women become more educated, they have less children, and therefore those growth rates are not as necessarily as dynamic as they're portrayed. The question here is that what is happening in Africa is that we're seeing Africa becoming older, and where you currently have a population of over 60, where you have about a 5% rate at the moment, that's going to be over 25% by the time we get to 2050. And I just wondered, on that specific statistic and on that dynamic, how is the world of private equity investing changing across Africa in relation to catering for the older consumer? Are you seeing that more and more every day, or is this something that you need to start looking at as an industry as a whole?
Go ahead, Greg.
Yeah, no, that is surprising. I mean, for us, as we've been fundraising and last year and looking at some of the macro stats, the dependency ratio, so people below a certain age and above a certain age relative to the population of the working class, is going to continue to increase over the next 5 years in most of the markets we were looking at in Eastern and Southern Africa. It's going to lower, so there's going to be more working class people. And Ethiopia, for example, there's, I think, 55% of the population is below 25. And they're going to enter the working class, working age, and lower that dependency ratio. So for the fund life cycle we're looking at, 10 years, that demographic dividend is going to start to really play out, and that's attractive for us. And I think we see that in middle class in Ethiopia, some of the other markets, that it's becoming bigger, and that's part of one of the bigger attractiveness of sub-Saharan Africa is that demographic dividend is going to pay out. 2050, that maybe the trends start slowing down, but I think Africa at that point will still be in a much more better spot than Asia, Europe, the US, Latin America, where I think the population will be much older.
I agree with that. The age of the different, I think it's quite a varied picture. So yes, it's possible, I don't know about the old people, but it's possible that there might be 25% of the population will be over 60, but more than half will be under 25. And compared to where the rest of the world is at that point, the big majority of the working population are going to be in Africa. So as a result, that trend still follows. And I think even when we think about in the context of an older generation, and I think when you look at the life cycle of your average African relative to Asia, Europe, US, but even Asia, you're still seeing a big difference. But even in Africa, between Egypt and between Egypt and Ghana, for example, there's it's basically a difference with 20 years between 75 in Egypt and sort of another 55 in West Africa. So ultimately, the bigger trend, which is that more than half the population will be young, and a quarter, and the quarter of those by 2050, if they're 2.5 out of 10 billion, will actually be in Africa. So the key thing there is skills, because already a significant proportion of, I think it's something like 45% are under 18. And if the education outcomes are not there now, you have to basically kind of think about what are the skills that we're going to provide to that working population to ensure that it ends up being a demographic dividend rather than a time bomb.
So I'm turning 60 next year. I'll be coming into category. So to wrap our panel up, I'm just going to ask the panelists one question. I haven't prepared them for this one. I just thought about it. So you've got $50 million PA. What's the most exciting thing you could invest in Africa outside of your own funds and one another's funds? So just give a new business area, business sector, something that you really like that you do PA.
You didn't bring this up earlier.
He didn't.
You can say cannabis and not get arrested.
I'll jump in. I love the healthcare sort of investments that I see across Africa. Obviously we don't touch that at all. I think that's a fantastic avenue. It ticks just about every box you can Probably ticks every box you can possibly think of in terms of financial/impact in investing. And so,
Trends, everything.
and I don't see how you lose money on it if it's unless you do it poorly, and I don't think private equity will do it poorly from what I see.
So we would invest in healthcare and financial services. So I think given what we just discussed, I think it's going to be education and skills. And in particular, kind of working through the skills that then meet the needs that we need. So there's an energy deficit, and basically giving those skills to people who some of whom do not have a formal education. So there are ways in which somebody without a formal education can get skills and deliver to the workforce. So that's mine.
Rob, you're allowed to answer this too, by the way.
Good, thanks. I think, just across industries, but the tech-enabled space. I mean, it's an obvious one, but we're maturing from a pure fintech play into tech enablement across health, across logistics. Kobo 360 was here before us. Agro, exciting solutions delivered for real problems that have a young and tech-savvy population to adopt them. So I think that's a big play.
Greg?
Real estate. So we recently made a real estate investment in Ethiopia, and trends that I've seen play out in Asia with differentiated niche real estate products, student housing, micro units for young professionals that are moving from their parents' houses, higher end commercial, residential, shared office space. A lot of that's not available in a lot of African markets, and I think that'll be something that we look at with our real estate group at Cerberus.
Jay?
So I'm the last to say, and they've said it all, really. I think for me, though, I would agree with Rob, it's the tech-enabled side of things. There's going to be no growth in Africa over the next 5-10 years and beyond that is not businesses being touched by technology in one way or the other. So traditional businesses doing traditional things, but with a tech-enabled component. That's where the growth is going to come from.
And for me, it would be the eBay of data. My panels, thank you very much. Everybody, it's drink o'clock.